Have you noticed something unusual happening in the markets? For years, Bitcoin had a reputation for moving almost in lockstep with technology stocks. Whenever the Nasdaq rallied, Bitcoin usually followed. And when investors rushed to sell risk assets, Bitcoin often fell even harder. That relationship became one of the most accepted ideas in investing. If stocks struggled, Bitcoin was expected to struggle too. But over the past several trading sessions, that assumption has started to look less certain. While major equity markets have come under pressure, Bitcoin has managed to recover above $63,000 and has shown a level of resilience that many investors didn't expect. Now, 1 or 2 days of different price action don't necessarily change a long-term trend. Markets can produce short-term anomalies all the time. But experienced investors pay attention whenever an asset starts behaving differently from what history would suggest. Because sometimes, before a major move begins, the first thing that changes isn't the price itself. It's the behavior. And that's exactly what we're going to explore today. Is Bitcoin finally beginning to separate from traditional financial markets? Or is this simply another temporary move that will disappear once volatility returns? More importantly, if Bitcoin really is starting to trade on its own fundamentals rather than following Wall Street, what does that mean for the months ahead? Because if this is the beginning of a genuine decoupling, the implications could be much bigger than most investors realize. Bitcoin just pushed back above $64,000 while stocks around the world are shaking. And before you scroll past this thinking it's just another price update video, stop for 1 second. Because what's happening right now might be the first real crack in a pattern that has controlled Bitcoin for almost 4 years straight. This is not financial advice. Everything in this video is for education and general market discussion only. Always do your own research and speak with a licensed financial professional before making any investment decision. All right, let's get into it. If you're new here, welcome to the Wealth Continuum, the place where we break down what's really moving behind the price charts, not just the headlines everyone else is repeating. If that sounds like your kind of channel, you already know what to do. Now here's my question for you before we even start. Comment below and tell me, are you watching this on your lunch break right before bed? Or are you actually sitting there with your portfolio open in another tab? I actually want to know. Type it below. I read these. Okay, let's talk about what's actually going on. For years, there's been this unwritten rule in the markets. Bitcoin moves with tech stocks. When the Nasdaq climbs, Bitcoin climbs. When investors panic and dump risk assets, Bitcoin usually gets dumped even harder. That relationship became so accepted that most traders stopped questioning it. It just became the rule. Nobody really challenged it because for a long stretch, it kept being true. And when something keeps being true long enough, people stop treating it as an assumption and start treating it as a law. But right now, in the first week of July 2026, that rule is being tested in a way we haven't seen in a long time. Equity markets have been under real pressure the past several sessions. Meanwhile, Bitcoin, which spent late June sitting near $58,000 and $59,000 after a rough first half of the year, has clawed its way back above $63,000. And at the time I'm recording this, it's trading right around $64,000. Now here's where I need you to stay with me, because the next part is the part most people are going to miss. 1 or 2 strong days doesn't prove a trend has changed. Markets throw out false signals constantly. I'm not here to tell you Bitcoin has permanently broken away from stocks forever, because that would be irresponsible. But here's what caught my attention, and what caught the attention of a lot of experienced traders this week. Bitcoin gained more than 6% over the past 7 days. During that same stretch, equities were struggling to hold their footing. That gap is unusual, and unusual gaps are exactly the kind of thing that show up right before something bigger starts. So here's the real question I want you thinking about for the rest of this video. Is Bitcoin actually starting to trade on its own logic? Or is this just noise that disappears the second volatility comes back? Hold that thought, because the answer might matter more than you think. Let's rewind for a second, because context matters here, and I don't want to just throw numbers at you without explaining how we got to this exact moment. For nearly 4 years, Bitcoin has lived completely in the shadow of macroeconomics. Every inflation report, every Federal Reserve meeting, every jobs number, every move in Treasury yields. All of it seemed capable of swinging Bitcoin within minutes, like it was just another ticker on a Wall Street trading desk screen. And honestly, that wasn't irrational. As more institutions bought in, Bitcoin started behaving like their other risk assets. When rates went up, Bitcoin usually dropped. When liquidity loosened up, Bitcoin usually recovered. Big funds started trading it almost like an extension of the Nasdaq. Risk on helped both. Risk off hurt both. Simple as that. It made sense from a trading desk's point of view. If you're managing billions of dollars and Bitcoin behaves like a leveraged version of tech stocks, you trade it that way, and that behavior becomes self-reinforcing. But quick reminder here, because this is important. Markets do not stay the same forever. Gold went through this exact kind of evolution decades ago, shifting from an industrial and jewelry-driven asset into a macro hedge that traders watch for completely different reasons. Government bonds evolved too, changing their relationship with equities more than once over the decades. Even tech stocks have gone through stretches where old patterns stopped working and new forces took over completely, like when some megacap names started trading more on interest rate expectations than on their own earnings. So the real question on the table right now is simple. Has Bitcoin hit that same kind of turning point? Here's what's really concerning some analysts, and I mean concerning in a good way if you're holding. Bitcoin just went through one of its roughest first halves in years. It started 2026, trading above $93,000, and by the end of June, it had fallen all the way down into the $58,000 to $60,000 range, a drop of well over a third from where it began the year. That's brutal. That's the kind of drawdown that usually triggers panic selling, capitulation, and a wave of people swearing off crypto completely, at least until the next rally pulls them back in. And yet, when stocks started wobbling again in early July, Bitcoin didn't collapse with them. Instead, buyers stepped in hard around the $62,000 level. Over $450 million in short positions got liquidated in a single stretch, which mechanically forced even more buying pressure into the market. That's not proof of a new trend on its own. But it tells you something about where demand is sitting right now, and it tells you that a meaningful number of traders were positioned for further downside and got caught leaning the wrong way. Subscribe if you want to see how this story develops, because I promise you, this is only the setup. Now stay with me, because this next part is where it gets really interesting. Bitcoin exchange, traded fund flows had been bleeding out for weeks. Institutional money was leaving, and a large chunk of that outflow was tied to just one or two of the biggest funds trimming their positions. Then, just in the past couple of days, those flows flipped positive again, with tens of millions of dollars in fresh inflows coming back into the market. After weeks of outflows, that reversal matters. It's a signal that some of the bigger players are starting to step back in, even while sentiment on the street is still nervous, and even while the headlines are still mostly negative. And speaking of nervous, the fear and greed index for crypto is currently sitting around 23, which is deep into extreme fear territory. Here's the part that should make you pause. Extreme fear readings historically have not been the moment to panic. They've often been the moment right before a shift. Not always, but often enough that seasoned investors pay close attention when fear is this high and price is still holding. Think about it logically for a second. If fear is this extreme and yet nobody is actually able to push the price meaningfully lower, that tells you something about the balance between buyers and sellers that a headline alone will never show you. Quick gut check for you, comment below. When you see extreme fear on the sentiment index, does that make you want to buy or does it make you want to run? Be honest. I want to see the split in the comments. Here's what they're not telling you in most of the headlines you're scrolling past today. The type of investor holding Bitcoin right now looks almost nothing like it did a few years ago. Back then, this market was mostly retail traders chasing momentum, jumping in and out based on whatever was trending that week on social media. Today, the ownership base includes pension funds, corporate treasuries, asset managers, family offices, and a growing base of spot Bitcoin exchange traded fund investors who typically think in years, not days. These are not the kind of investors who panic sell because of one bad headline. Many of them are working off multi-year theses, and that changes market behavior. Not overnight. Gradually, quietly, the kind of shift that's easy to miss until suddenly it isn't, and by the time it becomes obvious to everyone, the easiest gains have usually already been made by the people who noticed early. Here's something worth sitting with for a moment. Some of the largest corporate holders of Bitcoin have been making very different decisions from each other lately. One well-known corporate treasury has continued adding to its holdings even during the drawdown, treating the lower prices as an opportunity rather than a warning sign. Meanwhile, another major holder has been trimming its position gradually, selling smaller chunks to fund other obligations. That kind of split behavior among big holders is actually healthy for a market. It means conviction isn't universal, which usually means the eventual move, whichever direction it goes, will be based on real supply and demand rather than everyone acting on the same signal at the same time. Here's something I want you to really sit with for a second, because it's the whole heart of this video. Most people watching a video like this assume Bitcoin's future is only about price. But if you've been investing for any length of time, you already know that price is the last thing to change, not the first. Before price moves, the narrative shifts. Capital flow shifts, market structure shifts, ownership shifts, liquidity shifts. These things happen quietly, usually long before anyone is calling it historic on the news. Think back to previous Bitcoin cycles for a second. The strongest rallies almost never started when everyone agreed the bull market was back. They started while people were still arguing about whether the recovery was even real. By the time the consensus caught up, a huge part of the move had already happened without them. If you go back and look at how people talked about Bitcoin during past recoveries, the comment sections were always full of skepticism right up until the point where it stopped mattering, whether people believed it or not. History doesn't repeat exactly, but it rhymes more often than people want to admit. So here's the big question I keep coming back to. If stocks are under pressure and economic uncertainty hasn't gone anywhere and interest rate policy is still a live conversation, why hasn't Bitcoin fallen much further? Where is this buying actually coming from? Is it long-term institutional money? Is it exchange-traded fund investors finally coming back after weeks on the sidelines? Or is something bigger starting to build underneath the surface that most people simply haven't noticed yet? Because the answer to that question tells us whether this bounce has real foundations or whether it's just another short, lived relief rally that fades the moment volatility returns. Hit like on this video if you've ever felt like the mainstream headlines are always one step behind what's actually happening in these markets. You already know what I'm talking about. Now let's talk numbers for a second, because I want to ground this in reality instead of just vibes. Bitcoin's total market value right now sits at approximately $1.28 trillion, still making it the dominant force in the entire crypto market by a wide margin, controlling somewhere around 54 to 55% of total crypto market value. Its all-time high was $126,210, reached back in October 2025. At today's price, Bitcoin is still sitting roughly 49% below that peak. Let that sink in for a second. Bitcoin is still down almost half from its all-time high, and yet it's showing this kind of relative strength while stocks are struggling. That combination, a deep drawdown plus unexpected resilience, is exactly the kind of setup that tends to get overlooked until it's too late to act early. This is where it gets really concerning if you're only watching price and ignoring everything underneath it. Analysts are now watching $65,000 to $66,000 as the next meaningful area to reclaim. If Bitcoin can push through that zone and hold it, the conversation shifts from, is this a dead cat bounce, to, is this an actual trend reversal? Above that sits the 66,000 to 67,000 range. Then the bigger structural test near the high 60,000s, and eventually the mid 70,000s, where the true medium-term ceiling has been sitting based on on-chain data. Some longer-range forecasts even point toward the $85,000 zone as the next major structural resistance if momentum genuinely builds, though that's further out and depends entirely on whether the current bounce actually holds. On the downside, if this recovery fails and sellers regain control, $58,000 remains the level everyone is watching as the line in the sand. That level has already been tested once this year and held. Lose that convincingly a second time, and the conversation changes completely, opening the door toward the mid-50,000s, a level that would represent a serious breakdown from where things stand today. So really, this whole story comes down to one battle. Can buyers hold above the low 60,000s long enough to build a real base, or does this turn into just another failed bounce inside a longer downtrend? Let me pause here for a second and talk about the part almost nobody brings up, the supply side of this equation. Bitcoin has a hard cap of 21 million coins. As of right now, only a small fraction of that remains to be mined, somewhere around 1 million coins left, which is less than 7% of the total supply. On top of that, several million coins are widely believed to be permanently lost, locked away in forgotten wallets, or destroyed hard drives from the earliest years of Bitcoin's existence. That means the actual pool of coins available for trading is smaller than the headline number suggests, and it keeps getting smaller every single year as more coins get locked into long-term cold storage by holders who have no intention of selling anytime soon. Think about what that means when you combine it with everything we just talked about. If institutional demand keeps building, even gradually, against a shrinking available supply, that's a mathematical pressure that eventually has to show up somewhere. Not on a specific date, not on any guaranteed timeline, but structurally, it's the kind of setup that tends to matter over a multi-year horizon rather than a single news cycle. I'm not going to sit here and tell you I know the answer with certainty. And honestly, anyone who tells you they do with total confidence is not being straight with you. But here's what I will say. The ingredients for something bigger are lining up in a way we haven't quite seen before in this cycle. Positive fund flows returning after weeks of outflows. Extreme fear readings while price holds steady. A wider base of long-term institutional holders instead of pure retail speculation. Short liquidations forcing mechanical buying pressure. A shrinking available supply against a backdrop of growing structural demand. None of these things alone would matter much. Together, they start to paint a different picture. Here's where it gets really concerning again. But from the other direction, because I want to be fair about the risks here too, not just the bullish case, none of this guarantees anything. The stock market weakness driving part of this narrative could resolve itself quickly. And if equities stabilize and rally, some of the capital currently finding its way into Bitcoin as an alternative could just as easily flow right back into growth stocks. Interest rate policy remains a genuine wildcard, and any surprise from central bank commentary could hit both markets at the same time, erasing this apparent divergence overnight. Corporate sellers trimming positions to fund other obligations could accelerate if conditions elsewhere get tighter. And sentiment can flip fast in this asset class. Extreme fear can become extreme greed within weeks, and it can just as easily slide into outright panic if a handful of large holders decide to sell into any strength. So hold both of these thoughts at the same time. The setup looks interesting, and the risks are completely real. Those two things are not contradictions, they're just what investing actually looks like when you're being honest about it instead of only telling you the exciting half of the story. Let's take one more detour before we close this out, because I think this comparison actually helps put everything in perspective. Go back to 2022 for a second. Bitcoin was crushed that year, dropping from nearly $70,000 down into the $15,000 range as an entire wave of exchanges and lending platforms collapsed around it. That was a real crisis, with real structural failures inside the crypto industry itself. This time is different in a very specific way. No major exchange has failed, no stablecoin has broken its peg. The pressure this time is coming almost entirely from outside forces, interest rate expectations, and a broader pullback in risk appetite across stocks, rather than anything breaking inside the crypto ecosystem itself. That distinction actually matters a lot when you're trying to figure out whether a recovery has real legs or not, because external pressure tends to resolve faster than internal structural damage. Now compare that to 2020 and 2021, when Bitcoin went on one of its most explosive runs in history, climbing from under $10,000 to over $60,000 in about a year, largely on the back of new institutional adoption and the first wave of corporate treasury buying. Nobody was fully prepared for how far that move went, including plenty of professional traders who kept calling the top far too early. The lesson from that stretch isn't that the same thing has to happen again. It's that when institutional adoption accelerates quietly in the background, the eventual price move can surprise almost everyone, including the people who were paying close attention. I bring this up not to promise you a repeat of 2020, because markets don't work that way, and anyone promising you that outcome is selling you something. I bring it up because the pattern of quiet accumulation followed by a move that catches the broader market off guard has happened more than once in Bitcoin's history, and it's worth having on your radar rather than dismissing simply because it sounds familiar. Comment below and let me know, were you around for the 2022 crash, the 2020 rally, both, or neither? I want to know how much of this audience has actually lived through a full cycle already versus watching one unfold for the first time right now. Before I wrap this up, one more question for you, and I actually want an answer in the comments, not just a like. If Bitcoin does hold above $63,000 through the rest of this month while stocks keep struggling, does that change how you personally think about it as an asset? Or would you need a lot more time before you'd actually believe it's decoupling for real? I'm genuinely curious where this audience stands, because the comments on this channel are honestly some of the sharpest takes I read all week. Stay with me, because I want to leave you with the piece that ties this whole thing together. The real story here might not be that Bitcoin climbed back above $63,000 or $64,000 this week. Plenty of assets bounce. That part isn't rare. The real story is why it was able to do that while a huge chunk of the traditional market was struggling at the same time. That difference, small as it looks on a chart today, could end up being one of the more important signals of this entire cycle looking back a year from now. Because remember what we talked about earlier, price is always the last thing to change. Narrative, ownership, capital flow, and market structure move first, quietly, while most people are still arguing about whether anything is actually happening. So here's what I want you to take away from this video. Keep watching 65,000 as the level that matters most for confirmation. Keep an eye on whether exchange-traded fund inflows keep building or fade right back out. Keep an eye on that $58,000 floor, because that's the level that decides whether this stays a recovery story or turns into something more painful. And keep asking yourself the question we opened with. Is this a genuine decoupling starting to form, or just another temporary gap that closes the moment the next scary headline hits? If this video actually made you think differently about what's happening in the market right now, do me a favor and share it with someone who's been asking you about crypto lately. It genuinely helps this channel more than you'd think, and it might help them avoid making a decision based purely on fear or hype instead of actually understanding what's happening underneath the surface. And before you go, one last thing. How's the weather where you're watching this from? Drop it in the comments. I like knowing who's actually here reading this far into the video. If you made it this far, you're clearly someone who actually cares about understanding markets instead of just reacting to headlines, and that's exactly who this channel is built for. One more thing before you click away. If you've been holding through this drawdown, comment where you first bought in I'm curious how many of you have been through a cycle like this before, and how many of you this is the first real test of your patience. Subscribe to the Wealth Continuum if you want to keep seeing this kind of breakdown before it becomes the story everyone else is talking about. I'll see you in the next one.